Welcome back. This is a quick lesson on the use of constraints in risk management. Let's jump right in. Many organizations implement constraints to limit risk exposure, such that the organization can survive through the toughest of economic conditions. However, determining an appropriate level of constraint is a difficult balance between being too restrictive, such that profitability is impaired, or not restrictive enough, leading to financial distress and bankruptcy. Risk managers for large organizations should also consider the diversification benefits or offsetting positions across business units. If there is a low correlation of returns between units, each unit may be allowed to take on more risk individually, as the bust of one unit may be a boon to another. Among the constraints most often used in risk management are risk budgeting, position limits, scenario limits, and stop-loss limits. Let's briefly go through each of them. In risk budgeting, the total risk appetite of the firm or portfolio is agreed on at the highest level and then allocated to sub-units or sub-activities. Risk budgeting typically rests on a foundation of either VAR or ex-ante tracking error. For example, a bank might establish a limit on its total VAR and allocate this risk appetite among the basic risk types, that is, market risk, credit risk, and operational risk. Each of the sub-units, which can be categorized according to business units, geographies, or activities, will be allocated the level of risk it is allowed to take. For instance, the bank might allow its Asian business unit to use 50% of its market risk capital, 30% of its credit risk capital, and 40% of its operational risk capital. Risk budgeting can also be based on relative VAR or ex-ante tracking error. If you recall, this measures the risk of a portfolio relative to a chosen benchmark. In other words, ex-ante tracking error measures the risk from making deviations from the benchmark portfolio. For example, a pension fund may set a limit for total risk of deviation from a multi-asset class index, and then allocate that risk to allow for deviations in asset class allocation, deviations in allocations to specific industries, and deviations in allocations to specific securities. One limitation of VAR-based risk budgeting is that it does not take into account risk exposures to a particular risk. For example, multiple subunits of the same organization may be heavily invested in the stock market, such that the organization's exposure to the market is excessive. Position limits are one way to ensure adequate diversification of risk exposure on an organization level. Individual unit or portfolio managers may be issued limits. Such limits may be based on asset class, issuer, currency or country, investment category, or size of long-short positions. Position limits can be expressed as currency amounts or as percentages of a portfolio's value. Position limits can also be based on a liquidity measure, such as average daily or weekly trading volume. Scenario limits are limits on expected loss for a given scenario. The risk manager may have a number of scenarios to analyze, and if the estimated loss for a given scenario exceeds the limit, action would be warranted to lower the risk of the organization. Stop-loss limits require a reduction in the size of a portfolio or its complete liquidation when a loss of a particular size occurs in a specified period. We have earlier noted that one limitation of VAR is that cumulative losses can turn out more than expected. Stop-loss limits help to mitigate possibility of further loss by selling before losses accumulate. An alternative to the selling of securities is to impose a requirement to undertake hedging activity, like the purchases of protective options. The magnitude of the hedge should increase as losses increase. This approach, called drawdown control or portfolio insurance, is more dynamic and more sophisticated than to just sell the securities. And lastly, let's briefly discuss how risk measures may be used in capital allocation decisions. We've learned under corporate finance that managers often allocate capital based on the project's IRR. In general, projects with expected return greater than the shareholders' required rate of return are selected because they're expected to increase shareholder wealth. This process, however, does not directly consider the risk of each project or unit and their contribution to the entire organization. Risk management requires that the risk exposure for each use of firm capital be considered. The considerations are complex and outside the scope of the curriculum. In most cases, the exercise is similar to risk budgeting, that is, to calculate the VAR in percentage for each of the business units or activities and then allocate capital to each unit accordingly, such that the organization's total VAR does not exceed the limit set by the management. Risk management and the process of capital allocation is often used in cases where leverage is used in the portfolio or in which the strategy has meaningful tail risk, meaning that losses in extreme events could be far greater than would be expected for a portfolio of assets with a normal distribution. And that's all you need to know about constraints and capital allocation in risk management. You just need to have a qualitative broad overview of this subject. Calculations will not be required. Up next, we conclude this topic with a discussion on the applications of risk measures. See you again.